We will now explore FTSE Small Cap market and go through the pros, the cons, the benefits, and the reasons why investors not only choose to invest and the lucrative nature that may be attached, but naturally with that there will be some cons attached. Okay, so the FTSE Small Cap Index represents a segment of the UK stock market that purely focuses on smaller companies. Okay, it is part of the overall FTSE Russell family. Um, there are a multitude of indices within the Russell group, which unfortunately we won't be covering in this chapter, but we will have a course coming out that will go into those companies. But when it comes to the FTSE Russell, it is uh, predominantly indices focusing on very small, innovative based companies. Okay, the FTSE small cap will have various array of sectors, which will include tech companies, healthcare, industrials, um, but be fully aware there is that heightened level of risk compared to more established companies. So you will be more susceptible to economic downturns, market volatility, as well as liquidity constraints. One way of using the small cap market is always to use it as a potential benchmark, especially if you do have a portfolio of small cap stocks and you want to know how well your portfolio has done compared to the general market. It's always a great market to use as a benchmark, as is the FTSE 100 if you are predominantly focusing on the larger market cap companies. So always understand the benchmarking element to it. Investors overall, more often than not, will have some degree of exposure to small companies, growth companies, purely based on the fact that they are at their growth phase, they are at the infancy stage, so there is the potential of exceptional upside. So that's one thing to be fully aware of. If you are looking to advise or direct clients into you know this market, it's essential that you do a lot of research into individual stocks, as there's not a huge amount of research and analyst reviews on these companies, so it's important that you do as much research as possible. So we're going to touch upon the characteristics of the FTSE small cap, and again we'll be touching on very similar topics as we've done with the other indices, as well as the ones we will be looking at moving forward. The liquidity element's important. You may always wonder why I talk about liquidity. It's important when you are speaking with investors and you are looking to provide advice or strategies and solutions, that you can place your client in the right investments that match their investment objective. Okay, so understanding the risk associated with all the major indices will help you construct a better portfolio, whether it is growth that you're targeting. What element of risk are investors prepared to take in order to get that growth? Are they prepared to look at small, highly illiquid companies in order to hold for a duration of years and potentially see a return? Or are they more focused on investing in highly liquid, large companies which provide a solid dividend? So it's always essential that you understand the liquidity elements of all these companies, as if you don't, um, you can be susceptible to big gapping and big price fluctuations. So when it comes to the small cap liquidity, the market is influenced by similar factors as those, affecting the broader markets. So that's one thing to be fully aware of. But the lower liquidity of small cap stocks will lead to wider spreads, and it will hamper trading constraints. It will cause prices to deviate from their current value. Um, but it does present opportunities to patient investors willing to take advantage of, any form of market, distortion. Okay, one number of the key factors that reflect liquidity will be the trading volume. When we talk about volume, that's the amount of buyers and sellers you tend to have within that stock. Higher volume always leads to higher liquidity, less volume, vice versa. The market capitalization of the small cap stocks are going to be considerably lower compared to large cap stocks, and that's naturally when the volatility will come into effect, and it will have a massive impact on overall liquidity. Now, diversification is a big element for investors if they are looking to spread their risk and willing to benefit from potential further upsides or M&A targets. It's a great way to diversify, as when it comes to not only the AIM market but the small cap market in general. It has seen a huge amount of investments in the last number of years, and it always tends to do very well, especially in a robust market. So if you do your research and go onto the websites, as I mentioned earlier on, like Hargreaves Lansdown, for example, and you look at the small cap market and then you just click on the top performers, you've got companies which are up 200-300% year on year. So there are some serious finds within that. So when it comes to investing in the market in general, the stocks, as I mentioned earlier, it does tend to have a less attention. They have less attention. No real financial analysts or media, have a huge amount of coverage. You will never see it on the news, and so little coverage can result in information gaps, and investors, who do conduct thorough research may uncover some serious undervalued or misunderstood small cap stocks, which can tend to do very well. So be fully aware of all these elements before deciding whether to invest and move forward. Now let's take a look into the type of investors that would be attracted to the FTSE small cap market. Straight off the bat, retail investors, and when we talk about retail investors, they are you and I, but the objectives may be slightly different. The FTSE small cap is not suitable for a range of investors, so it's very important that you understand client needs before directing them into this area. But if you do have an investor which is seeking high growth opportunities and willing to take a higher risk, they will be attracted to this sort of market. There is the potential for rapid expansion, and investors with an aggressive growth strategy may allocate a portion of their portfolio towards this arena. Long-term investors with a horizon of multiple years will be interested in small cap stocks, understanding that these companies will take time to realize their full potential, and being a patient investor may be better rather than a short-term investor that's looking for a quick gain. If you do have time on your hands and you're happy to buy and hold and just lock it away, it could potentially pay dividends in the long run. Fundamental investors, when we talk about fundamental investors, these are investors that focus not so much on the news, not so much on outside noise, but they look at the key metrics of a company. They do a hell of a lot of financial analysis to find the real value of a company. That could be looking at their a balance sheet, their P&Ls, their cash flow statements, their income statements, and from that they can gauge whether the company is coming from a good foundation and has a potential of growth. We will cover different ratios such as profitability ratios, investor ratios, as well as solvency ratios later, as that will all help you ascertain whether you wish to buy a company or not. Private equity and venture capital investors, they are often looking to seek exposure in small companies with high growth potential. So that is their aim, that is their business model. So having an acquisition from a venture capital trust could be advantageous, and they tend to be the usual investors. Institutional investors, not a huge amount, but there will be investment managers, fund managers, which are maybe focusing on building a trust based around small cap growing companies. So you will naturally tend to see fund managers rather active and looking to invest in this area. Okay, let's look into the pros and the cons of investing and having exposure within the FTSE Small Cap. Now, a lot of the pros and the cons will be pretty obvious, but it's still worthwhile going over them. One of the main benefits of investing in small cap is the growth potential. Compared to larger companies and more established companies, companies within their early stages of development could experience a lot of rapid expansion. It's a great way of diversifying your risk. Okay, you are obviously investing into a slightly more riskier market, but the potential upside is greater if naturally it does come off. So it is a great way of spreading risk. A lot of these companies will be classed as undervalued. Okay, when we talk about companies being undervalued, they haven't reached their true potential. They don't get a lot of research. There's not a lot of reports being put out about them. So it's hard to say if they're at anywhere near their fair value. So there will always be companies which have the opportunity of expanding and moving forward. There is going to be some form of market inefficiencies. And when we talk about market inefficiency, these are, very small, very illiquid companies. And skilled investors can exploit this opportunity. There can be an opportunity for active investors to identify and capitalize on mispricing of stock. Okay, M&As is also one which I haven't put down, but it is a great opportunity for larger companies to acquire smaller companies, especially if they are potential threats in the future or they have got a market share that the larger company would require. So those are always great opportunities. When we talk about the cons, they are going to be naturally focused around volume and liquidity. When it comes to high volatility, this is based on the fact that there is less liquidity, there are larger fluctuations, and so there is increased risk to investors. Liquidity, there's not enough buyers and sellers, so the ease of buying and selling stock at the price you want is not always easy. That can tend to lead to, a financial instability, really, especially if data has come out and their earnings, their reports, their output, or their solvencies not where it needs to be. You will tend to see a lot of weakness within the stock. We have touched on the fact that there is limited analysis, and that can be a hindrance. You would rather not invest in something you do not know nothing about, and no one would expect you to. So research is going to be, very important. There is always a chance of business failure, and there is a high risk. Generally, less established and more high-risk businesses fail compared to larger, more established companies. So investors, should be prepared for the possibility that some of these companies are facing difficulties and even bankruptcy. That's naturally what you should always expect when going into an investment of this nature. With small cap stocks in general, they are not big dividend payers. They prioritize reinvesting profits into growth initiatives rather than paying dividends. So, if you're looking for dividends, focus on the FTSE 100. If you're focusing on accelerated growth, higher risk, then you might want to take your eyes over to the small cap market.